And it is time for the word on Wall Street. Top investors watching your money. And we watch the declines this morning with the Dow down 500 points. Joining me right now is Bull Tick Capital Markets Chief Strategist Catherine Rooney-Vera and Michael Lee, Strategy Founder. Michael Lee, great to see you both this Monday morning. Thank you so much. Unfortunately, it's another day, a new week, and we got the same old selling underway. Futures are declining about 500 points right now as interest rates move higher, Mike. We're looking ahead to the key inflation data this week. That's going to be the big focus when we get the April Consumer Price Index out on Wednesday and the April Producer Price Index out on Thursday. Your expectations and what do you make of this sell-off in stocks this morning?
Well, Maria, inflation is the key driver of asset price movements in 2022. So the stock market's not going to stop selling off until the bond market stops selling off. The bond market is not going to stop selling off until we're confident that inflation the rate of change of inflation has moderated. We're going to get two very big year-over-year headline prints this week, but I'd say to investors and people watching, that's not what's important for what's going forward. This year is the first year where we've had stocks down double digits in the first 5 months and bonds down double digits in the first 5 months, and it's because in January and February and March, we've had too high of month-over-month increases in inflation. At this point in the cycle, we should have very low numbers on a month-over-month basis. So first is the CPI. We're looking at 0.2% month-over-month increases on core inflation, so excluding food and energy. And then on PPI, we're looking at 0.5 percentage point on a month-over-month basis. If these numbers can stay low over the next couple of months, I think we could probably see a bottoming out in fixed income and some buyers start to step in and start supporting the 10-year and the 30-year, the long end of the yield curve. Okay, once that happens, I think you could see stock prices recover. So these numbers, this month and next month, if we get two low month-over-month numbers in this month and next month, I think we've seen the worst for now, unless the economy deteriorates dramatically at some point in the future. I think we could be looking near the lows if we can get some good prints. So I'm extremely hopeful, not only for myself, but for all my clients and all the investors out there that we do.
Well, I mean, look. Right now, we're looking at an estimate year over year for the CPI of 8.1%. That would be down from March's reading, which is 8.5%. If you see a reading year over year of 8.1% versus March, which was 8.5%, do you see that as moderating? I mean, it's only 1 month. But do you think markets rally if we get an 8.1% number, even though it's well above 8%, which is still a problem?
Well, Maria, it's on the core number. It's the month over month. These are going to be shocking headline numbers. And I can tell you prices are not going back down to where they were a year ago or 2 years ago. But what's the real problem we're facing right now is the month over month increase. At this point in the cycle, inflation needs to be decelerating, not accelerating.
Yeah.
Okay. And so if it starts decelerating, you can now handicap how many more rate hikes the Fed's going to need and where bottoms are going to bottom out. And then you could start valuing equity prices because every asset price in one way or another is based off the U.S. Treasury curve.